Intercorporate investments. It is quite common for companies to make investments in other companies, and the overall performance of a company will obviously depend on these investments. Hence, it is important for us to understand the different types of intercorporate investments, how they are accounted for, and the impact of these investments on the overall company. In section 2, we will look at the different types of intercorporate investments. In section 3, we will focus on investments in financial assets. Section 4 deals with investments in associates and joint ventures. And section 5 has to do with business combinations. This slide shows the 4 basic types of intercorporate investments. Let's start with investments in financial assets. Now, the idea here is that let's say we have a company C, and this company makes an investment in company B, where this investment represents 2% of the outstanding shares of company B. Now, obviously, company C has an investment in B, but this is a small investment, and company C will not really have a significant influence on the operations of company B. So when we have this situation where the influence is not significant, and this generally happens when the percentage ownership is less than 20%, then we say that this is an investment in a financial asset. Now, this financial asset can be in the form of the equity of a company. It might be a bond that a company has issued. And this investment can be classified in one of 3 ways. Either it can be classified as fair value through profit and loss, or it can be classified as fair value through other comprehensive income. And the third possible categorization is at amortized cost. We will discuss these terms in more detail shortly. We can also have an investment in associates. So let's say company C makes an investment in A, and over here C buys 30% of the shares outstanding of company A. Now, if C has significant influence over the operations of company A, then we say that this is an investment in an associate. Generally speaking, when an investment is between 20% to 50%, then there is significant influence, and we say that the investment is in an associate. And the accounting method used is called the equity method. This is quite important, and we'll be discussing this in a lot of detail. Then the third category is business combinations. This is where company C buys a significant portion of another company. So let's say we have company D, and C buys 70% of the shares outstanding of company D. So now clearly company C has a controlling influence in D, and this controlling influence generally happens when the ownership is 50% or more. And the accounting method used here is called the consolidation method. This is also extremely important, and we will be discussing the consolidation method in a lot of detail. And then the fourth category is joint ventures. This is where company C combines with another company. Let's say it combines with company E to create a joint venture. With this joint venture, both company C and E will have control of this joint venture, and the accounting method used is the equity method. Before moving on, I want to emphasize that this table is extremely testable. And let me give you a scenario that might show up. So you might be told that we have company C, which makes an investment in company X, and C buys 19% of the shares outstanding of company X, but it is deemed that company C has significant influence over the operations of company X. Now, if you look at the first 2 rows, with respect to the ownership percentage, we are over here, but with respect to influence, we are over here. So what do you go with? The answer is that it's the influence which matters. If you are told that company C has significant influence over company X, then X will be considered an associate and the method that you use is the equity method. So the key point is that the influence is what decides which accounting method to use. Moving now to section 3, investments in financial assets. Under IFRS, the accounting standard which deals with investments in financial assets is IFRS 9. This is effective for annual periods beginning on or after 1st January 2018, and this replaces an old standard. The old standard is IAS 39. With IFRS 9, there is a significant convergence between IFRS and US GAAP. For our purposes, the treatment of financial assets is essentially the same under IFRS and US GAAP. With the new approach, which is IFRS 9, we consider the contractual characteristics of cash flows. So, for example, we consider whether we have an equity investment where we might be getting dividends versus a debt investment where we get principal payments and interest payments. We also consider the management of the financial assets. So let's say we buy a given bond. The question is whether we are buying this bond for short-term trading activity or whether we are buying this bond for the long term. So we consider both these factors when categorizing financial assets. IFRS 9 also has a different approach to loan impairment relative to the older standard. With the new standard, we move from the incurred loss model to the expected credit loss model. The idea here is that with the expected credit loss model, we look at the past situation, the current situation, and we also look at what might happen in the future. So if the probability of credit loss increases, then that also is considered with the expected credit loss model. This was not considered in the old incurred loss model. The curriculum doesn't spend too much time talking about this, so as long as you just know this high-level fact that with the new standard, we also consider what might happen in the future, that's all you really need to know at this stage. As we've said before, the categories of measurement are shown here. A financial asset could be categorized as amortized cost, fair value through profit or loss, or fair value through other comprehensive income. The terminology used in the past is shown over here. We had held to maturity, available for sale, held for trading. Available for sale and held for trading are not mentioned in IFRS 9. You might still see these terms in old textbooks, but for our purposes, we are not going to be using these terms anymore. Let's now look at the classification of financial assets in a little more detail. The first high-level point, which you can see from this flowchart, is that debt instruments and equity instruments need to be treated separately. Let's first consider debt instruments. Debt instruments can either be recorded at fair value or at amortized cost. With fair value, we have two further options. Either we can have fair value through profit or loss, or we can have fair value through other comprehensive income. This is something we've seen at level 1, but I will still remind you what these terms mean. Fair value through profit and loss means that any unrealized gains or losses flow through the income statement. Fair value through other comprehensive income means that the instrument is shown on the balance sheet at fair value, but unrealized gains and losses flow through other comprehensive income. So unrealized gains and losses do not show up on the income statement. An instrument is classified as FVOCI. Now the question is, how do we determine whether a debt instrument is being classified as FVPL, FVOCI, or amortized cost? And that answer is shown in this flowchart, which has been taken from the curriculum. We initially apply two criteria, and these two criteria have to do with the business model and the characteristic of the cash flows. So the question related to the business model is whether the business objective for financial assets is to collect contractual cash flows. And the other question is, are the contractual cash flows solely for the principal and interest on principal? If the answer to these two questions or either of these questions is no, then the instrument is classified as fair value PL. So in this case, the instrument is categorized as fair value through profit or loss. If the answer to these two questions is yes, then management still has an option. The management might want to still designate this instrument at FVPL because the management might want to avoid asset liability mismatches. We don't need to get into too much detail. All we need to recognize here is that even though the answer to both these questions is yes, management still has the option of classifying a particular instrument as FVPL. Now, if the answer to this question is no, then the instrument is classified at amortized cost or fair value through other comprehensive income. So the question is, how is the choice made between these two? And the answer is, there might be a situation where a financial asset meets the criteria shown over here, but the idea is to hold this asset for some time and then sell it before maturity. In that case, it might make sense to classify the instrument as FVOCI. If the idea is to hold the instrument till maturity, then it should be categorized as amortized cost. Moving now to equity instruments. With equity instruments, amortized cost is not an option. So our only two categories are fair value through profit or loss, and the other one is fair value through other comprehensive income. So the first question is whether the equity instrument is held for trading or not. If it is held for trading, then it needs to be categorized as fair value through profit and loss. If it is not held for trading, then we still have an option. We can still decide whether or not we want to designate at fair value through OCI. If the answer is yes, then that's how it is categorized. If the answer is no, then it is categorized as FVPL. Let's now talk about reclassification. With respect to equity instruments, reclassification is not permitted because the initial classification of FVPL and FVOCI is irrevocable. So this is fairly straightforward. With equity instruments, we cannot do any reclassification. With respect to debt instruments, reclassification from FVPL to amortized cost is only permitted if the business model for the financial assets has changed in a way that significantly affects operations. So we can go from FVPL to amortized cost or vice versa, but this only happens if the business model changes and the change in business model is having a significant impact on operations. Now, this obviously requires judgment, and one would not expect this to happen very frequently. The final point for this section is that the analysis of operating performance should exclude investing activities. So, if you are evaluating a given company C, and this company has made investments in stocks and in bonds, these are financial assets. The performance of these financial assets, so any realized gains or losses, unrealized gains or losses, interest income, dividend income, this performance should not be considered when evaluating the operating performance. And just to hammer in this point, let's say a company is Microsoft, which is in the business of making software and offering software-related services. If Microsoft has made investments in some companies, the performance of these investments does not tell us anything about the operating performance of Microsoft. So when evaluating the operating performance of Microsoft, we should not consider the performance of the financial assets.